In this class, we are solving another WAEC May, June 2007, question 6. Remember, you can visit jadusconsulting.com to take the class that covers the topic we're solving. And then don't forget that you can always order for my study bag or my textbook, okay? You can reach me on the number displayed or pay into the account displayed as well. And then I want to say thank you again to Mr. Salam, Mr. Sadiq for their commitment to sponsor copies. If you're interested in getting free copies, you can let me know. So the question, it's May, June 2007, question 6. Says Ibrahim John runs a restaurant business from his apartment. He does not keep proper accounting records. The following information were extracted from his notebook: checks, stubs, and some discussions. Okay, and then we have land and building, motor vehicles, stock, debtors, creditors, bank, cash, drawings, and then each items mentioned have values or figures at the beginning of the year 2006 and at the end of the year 2006. So they are saying that we should prepare opening and closing statement of affairs, profit and or loss statement for the year ended and December 2006, and balance sheet as at that day. So basically, this is what we call incomplete records. Okay, so the idea is that the business owner or the business does not keep proper records. Okay, it keeps partial records, and then we prepare the account based on information that we have from the owner of the business. So that is what we're going to use here. So the first one says prepare opening and closing statement of affairs. Opening and closing on affairs simply is saying that we should show the position of the business in terms of assets and liabilities at the beginning of the period and then at the end of the period. So that is what we're going to do. So let's go. We have Ibrahim John, okay? So we're preparing statement of what? Affairs, all right? So it's going to be, let's use the word opening, closing. Okay, so let's do it tabular. The first one is 1st January 2006. And then we have 31st December 2006. Go to Naira here. So let's go. We have our what? Assets. So what are the assets? We have land and building. 1st January 2006 is 500,000. 31st December 2006 is 700,000. So we have land and what? Building. We have 500,000, 700,000. The next one is motor vehicle. Beginning of the year is 250, end of the year is 200. So we have motor vehicle. We have 250, we have 200,000. The next one we have stock. Beginning of the year is 20,000, end of the year is 40,000. So we have stock. Here is 20,000. Here is what? 40,000. The next one we have debtors. Beginning of the year is 12,000, end of the year is 35. So we have debtors. Beginning of the year 12,000, end of the year 35,000. Then the next one we have bank. Creditors is liability. Bank. So bank. What I'm seeing here, I'm seeing 5,000 at the beginning of the year, but I'm seeing a negative balance at the end of the year. That means that at the end of the year, it became an overdraft. So that means the bank here, we can have 5,000, but we can't have anything here because it's an overdraft. That's a liability. The next one is cash. Cash. Beginning of the year, we have 1,000. At the end of the year, we have 250. So that's it for the assets. So let's have our total assets. So what are the total assets? Okay, we are allowed to use our calculator. So our total assets here we have 500,000. plus 250,000 plus 20,000 plus 12,000 plus 5,000 plus 1,000. So we have 788,000. So here, this is 900,000. So that's 700 plus 200, 900,000 plus 40,000 plus 35,000 plus 250. So we have 975,250. So let's go. Less liabilities. So what are the liabilities in the question? The first item there, I can see creditors. Creditors, according to the question there, is 50,000 at the beginning of the period, 54,000 at the end of the period. So we have creditors, 50,000, 54,000 were deducted. The next item there, we have bank overdraft at the end of the period. So we have bank overdraft. No overdraft here, but we have here as 2,250. 2,250. So let's take them out of the assets now. So we have here 788,000 minus 50,000. So that is 738,000. Here we have 975,250 minus 54,000. Okay, minus 2,250. We have 919,000. So this is your capital. So this is your opening capital because it's at the beginning of the period. Total asset and total liabilities. Then this is the closing capital because at the end of the period. So that is it for the opening and closing of the. Let us say profit or loss statements. Now, we're preparing what we call incomplete record. So we are making use of what we have. Profit or loss statement for the year ended 31st December 2006. So we have probably want to know based on the items that we have. We're going to manipulate the items to know the income items and the expense items, and then we know if we made a profit for that year or there's a loss. So John's business is what we're preparing it for. So let's just say we have incomes, and then we have expenses. So we're going to look at how the items are behaving. Based on that, we'll know if it's an income or an expense. So let's go. The first item, they say land and building. At the beginning of the period, land and building is 500,000. At the end, it's now 700,000. So how do we interpret that? Various ways, basically. The truth of the matter is that if your phone, you bought it for 20,000, and then after some time, the price of that phone in the market appreciates to say 25,000. Technically, you've made a profit of 5,000. So what I'm saying is that, that because there's an appreciation in the value of this asset, there's an income item. Although there's something called impairment of asset, that is checking the cost of an asset and comparing to to the market value of the same asset from time to time to report the fair value of the asset. But that's not what I want to discuss here today. I want us to use a simple logic to understand this. Just understand that your assets, when you use them, they are supposed to depreciate. That the value is supposed to drop. Remember depreciation? I taught that on Jared's Consulting. Go and take depreciation. But what we're not saying is, instead of the value of the asset to depreciate, it's appreciated. So technically, there's what? A profit element. There's an income element. Because if you have to sell, you're going to sell at a higher price than what you want purchase. That's a way of one way of interpreting it. We can also interpret it that he bought more lands. if you have a plan of 500,000, by the end of the year, having 700,000, that means there could have been sales that he made from his business to generate more cash, out of which he bought the what? Land. So whichever way you interpret it, there's an income element. Okay? So let's just take the simple approach and move on. So there's land and building as at 1st of January, 500,000. At the end of 2006, it's now 700,000. That means there's an income element of 200,000. So let's just say income, okay, on what? Land and what? Building. We want to call it revaluation income, whatever. Let's use that. So we have 200,000. The next one is motor vehicle. Motor vehicle was 250 at the beginning of the year. By the end of the year, it's now 200,000. Consider there's a loss there. So that's what we call depreciation. Okay? So we can say depreciation is an expense on motor what? Vehicle. That's how much? 50,000. So the next item there is what? Stock. Stock at the beginning of the year is 20,000. It increased to what? 40,000. There's a profit element. That means there's sales. Let's call that sales. There's a profit element. Okay? So we can say sale of what? Of stock. 20,000. The next one there is debtors. Debtors increased from 12,000 to 35,000. Okay? So debtors are those that are owing the business. If someone is owing you 15,000, or sorry, 12,000 at the beginning of the year, by the end of the year, the person owing you is now owing you 35. That means you have sold something to that person again. So there's a credit sale that has entered the equation. So we can say credit sales, okay, of how much? Beginning of the period it was 12,000. End of the period it went up to 35,000. That means there's an appreciation of how much? 5 minus 2 is 3. 3 minus 1, 2, that's 23,000. So that's 23,000. The next one here, creditors. At the end of the period, creditors is 50,000. At the end of the period, it's 54,000. Creditors are those that the business is owing. Ibrahim John was owing 50,000 at the beginning of the period. At the end of the period, he's now owing 54,000. That means what? There is an increase in what? What he has purchased on credit. That's a cost. So it's an expense. So let's just say purchases, okay, on creditors. So we have how much there? 4,000. The next one, we have bank. Okay, bank is 5,000 at the beginning of the period, and at the end of the period is what? There's a negative balance. So let's say later to interpret that. Your bank is an asset, that's a debit balance. Okay, you can take a double entry for asset and liabilities and income and expense on that is consulting. I've taught that. So take that, you need that here now. So we have balance brought for, which is the opening balance of what? 5,000. If your opening balance is here, then for you to balance on the carry down should be here. But in this case, I'm saying that it's negative. That means the carry down is now here, 2,250. So for carry down to be something must have happened here that covers the total here. So bank is more like cash. Remember your cash at the cash book. How do we record it? When there's a receipt, we debit. When there's a payment, we credit. So now we're having 5,000 on the debit side, having 2,200 on the debit. That means something has happened on the credit side. So what happened on the credit side? Payments. What could that have been? Maybe we paid for an expense, or maybe we made purchases. They are both costs. So let's pick one. Let's pick purchases. Purchase of how much? This is 7,250. So that both sides will be equal. 7,250, 7,250. So this becomes balance brought down here of how much? 2,250. So we're taking purchase of how much? 7,250. The next one, we have debtors. I think we've already treated debtors anyway. Treated debtors. Debtors, we have 12,000 increasing to 35,000, so difference is 23,000. So the next one there is cash. So we have cash. Cash. The same way we have balance brought forward of 1,000 according to the question. Then it came down to 250. That means something has happened here to reduce the 1,000 to what? 250. Your cash is the same thing. If you receive money, Debit, if you pay money, you want. So there's a payment that brought the money down to 250. So it could be expense, it could be purchase. So let's pick purchases. No, we're just, so that will be what? 750. So both sides becomes 1,000. 1,000. So here becomes balance brought down of what? 250. Closing balance. Okay. So let's go. We have purchases again of how much? 750. So the next one I can see drawings. Drawings happen when the owner of the business is taking either cash or goods from the business for his personal use. Okay, so that's more like a cost. Okay, but it is debited to the what? Owner of the business. But the question is, drawings have a debit balance, just like the way you balance your expense and your assets. But now the question I'm asking you is, at the beginning of the period, there was no opening balance for drawings, but at the end, it went up to 12,000. So something must have happened. So we have drawings. Balance brought forward, nothing. But balance carried down is 12,000. So something must have happened. Okay? Something must have happened here. Do you understand? For the owner of the business to have money to take out. Okay? So what happened? So it's either he took what? He took goods or he took cash. And for him to take cash, it means he must have made sales. Okay? So let's assume he took cash. For him to make cash, he must have made sales. So there must have been, okay, some sort of what? Cash sales of 12,000 to cover up for the drawings that happened within the what? Period. So we have a drawdown of what? 12,000 here. So let's take another sales of what? 12,000. So is there another item there? Okay, that's about the last item. So let's quickly add up. So for our income, what do we have? 200,000 plus 20,000 plus 23,000 plus 12,000. So what do I have here? I have 255,000. So what is the expense? I have 50,000 plus 40,000. Sorry, 4,000 plus 7,250 plus 750. So what do I have? I have 62,000. So if you take out your expense from your what? Income. Okay? Take out your expense from your income. So we have 255,000 minus 62,000. We have 193,000. So this is your what? Net profit. If it were to be that this is higher than this, then I would have the what? A net what? Loss. So that's requirement B. So this is A. So this is what? B. So the requirement C, they say we should prepare balance sheets at that date. So this have to go off. So let's prepare a balance sheet. Balance sheet as at 31st December 2006. So we can use, let's use the vertical format. And as well as the T format, let's use the vertical format. So we have assets. So what are the assets? Based on the question, you can even go through your student affairs to pick them up. Land and building here, we have land and, okay, well let's do it this way. So we have assets, so let's go. We have fixed assets, okay, or non-current assets. So what we have? Land and what? Building. At the end of the period, we're reporting at the end of the, so that would be what? 700,000 here. What's the next as fixed asset? Motor vehicle. We have motor. At the end of the period, it's now how much? 200,000. Any other asset item there, or fixed asset item there? No, so this is 700 plus 1, that would be what? 900,000. So the next one is what? Current what? Assets. What are the current assets? Stock. Stock here at the end of the period is what? 40,000. What's the next thing? Debtors. At the end of the period, debtors here is what? 35,000. Okay? So what else? Bank at the end of the period is overdraft. That's liability. Cash at the end of the period is what? 250. So if we add, this should be 0.5 to 250, 575, 250, 75, 250. So this plus this will be what? 0.5 to 579, 975. So we have this to be your what? Your total asset. So let's go down. Liabilities. What are liabilities we have here? We have our short-term liabilities based on the question. I think that is creditors. We have creditors. What's the creditors according to the question? Creditors here is 54,000. Okay, so we have bank overdraft. That's 2,250. Okay. So if we add, this is 0. This is 5. So this is 2. This is what? 7. This is 5. Right? This is 7. This is 0, 0. This is 6. 6. 0 plus 0, 0. 0 plus 5, 5. 0 plus 2, 2. 4 plus 2 is 6. Then this is 56. So the next one we have capital. What's our opening capital? Opening capital is 738,000. Okay? So we have let's put it here, 738,000. So what do? We add net profits. What's the net profit in the question? 193,000. We have 193,000 less. What's the drawing in the question? Drawing in the question is let's see, 12,000. So let's less drawings. 12,000. So if you use the calculator there, what will you have? Okay, we have 738,000 plus 193,000 minus 12,000. So that's 919,000. So we have 919,000. So let's add. So you're adding 919,000 plus this 919,000. Okay, plus this is 56,250. 56,250. So we have 975,250. So this is your what? Total liability. So this total liability is 975,250. Total asset is 975,250. So this explains, okay, the position of John's business at the end of the year. Okay, so you can go to charlesconsulting.com to actually take a full class on this, explaining incomplete records, using incomplete records to, show the position of what the business. Don't forget, you can get my textbook as usual. You know how to get that now. Okay, and then thank you, Mr. Salam, Mr. Sadiq, for the commitment. I appreciate it. If you need free copies, you can let me know, so we'll put you in the plan. Thank you.